Welcome to Breaking Ground. I'm Steve Kliegerman, and I am honored to be with Orest Tomaselli, founder and is it president, CEO?
I'm the president of project review at
CondoTek.
CondoTek and the founder and CEO of Strategic Inspections.
Right. So Orest and I have known each other for quite a long time, and we've worked together on a lot of projects. What CondoTek does is that they work with developers to do reserve studies and Fannie Mae approvals and work through all of the problems that people might have in helping to get their projects approved for financing.
Yeah.
So, Orest, thanks for joining. It's great to see you, buddy. It's great to get to catch up a little bit before. So tell us about how did you get into this? How did this start?
So I started in the mortgage business, I think, right out of college, right? And my brother was a mortgage broker and kind of pushed me into that business. And I started working for other larger firms. And I just loved the condo side of the business. And I loved the compliance side of that side of the business. And I started really kind of pushing myself into that compliance world. And I just woke up one day and said, I want to start my own company, and did, on providing lending compliance to condominium associations and developers. And it has spiraled since then in a really great way.
So were other people doing that before you started doing this?
So interesting.
Because no one ever approached me for this until you and I met through Gary.
So funny enough, there were two other people in the country. So there were three of us when I joined, and I launched at the time National Condo Advisors. Three people in the entire country that would handle most of the condominium project approval in the U.S. And I think one of those firms is still in business right now, 20 years later or whatever it is. But yeah, there were not a lot of people who had that expertise. Yeah.
That's you had a lot of foresight.
Yeah, so there's something to be said for having a niche business too. There's a lot of extra work that is involved in doing that, but yeah, a little bit of foresight too.
Absolutely. So, tell me, over the 20 years or so that you've been doing this, how have things evolved? How have things changed?
It's been interesting. The last 2 or 3 years have been really surprising for us. I mean, so what's happened is that, in the past, there was always a home for a residential mortgage with any of the big box lenders out there, or some of the non-warrantable lenders that provide mortgage financing in new construction developments and existing established condo properties. And that's starting to change. Agency lending guidelines have changed in such a way that, everybody kind of brings it back to the tragic tower collapse in Surfside, Florida. And that was really the catalyst for lots of change, with not only within the mortgage world and the lending world, but also the insurance world and Florida as a whole, and now bleeding into the rest of the country. So there's been massive changes in what it takes for these condominium associations and condominium properties to be compliant with lending guidelines. And that, I didn't think that was ever going to happen. It was always a best practice thing, like, oh, you should do this, this, or this in order to get the best rates for mortgages for your purchasers. But now there's almost a requirement. There is a requirement for these properties to get compliant, to get mortgage financing.
Now, everyone thinks that complying really only refers to conforming loans.
Right.
Help us demystify that.
Yeah. So to some extent, that used to be the case. Like if there was a luxury condominium building in Manhattan and somebody was looking for a $2 or $3 million mortgage, that was kind of a relationship loan. So regardless of, what the building looked like, even if it was falling down, if that borrower had $5 million sitting in the bank was going to make that loan. It was something that we kind of always dismissed, because we were always like, oh, there's only a small portion of people who have those types of finances. Turns out there were a lot of people that had that type of capital sitting in a lot of accounts in New York City.
Especially here in New York City.
Yeah, there were a lot. But that has kind of changed across the whole entire marketplace. Essentially what's happened is that agency lending guidelines, Fannie Mae and Freddie Mac lending guidelines, as they are written, essentially have bled into portfolio lending. And if your condo or cooperative property is not compliant with those agency lending guidelines, and or at worst, that one of those agencies says you're ineligible for residential mortgage financing as a building entirely, there are lenders, regardless of how much money you have sitting in their banks, that will not lend in those buildings.
what would make a building ineligible?
There's a lot.
Give us the highlights. What are the more common things that you come across that, part of your job and part of my job in working with you is to get you in front of the developer early so that you don't have those issues and that you plan properly for them. So what are the more common things that come up that are red flags? Yeah.
So there's a couple. The big ones, if you look at the data that we have at CondoTek, we're essentially a tech company, and we have data on over 100,000 condominium associations in the country. What we find is that there's this top 5 reasons for ineligibility that I've put together. The number one reason is insurance noncompliance. Lending agencies have really crafted very specific and strict insurance policies for condominium and cooperative properties. And on new development side, typically on day one, insurers don't create policies that are compliant with those guidelines. And that's a big issue. Not only does it take some time to unwind, but sometimes the cost of that insurance policy, the way it's supposed to appear, or the way it's supposed to be, is much higher than originally quoted. And developers are, not thrilled about finding that out at the last minute or postponing a closing as a result of it. The other big issue in new development is development groups not substantially setting up their operating accounts with reserves. So we're setting up the condominium association so that there's a reserve contribution, or not getting a reserve study on day one to figure out what the appropriate costs are going to be for residential homeowners for the repair and maintenance of the common area components in the property. If any, those are the 2 biggest reasons we see reserve noncompliance and insurance noncompliance. And we handle all that really on day one so that they don't have a problem with it and don't delay a closing and don't find out that they need to write a check for another $100,000 to an insurer, a day before the first closing. Those are and it happens a lot, by the way.
Yeah. Well, and I would imagine also, I know in the past, percentage of commercial versus residential has been an issue. Particularly, there's a lot of larger condo projects, either here in New York, but also nationally, very large condo projects, and they're multifaceted projects, right? They're not just residential anymore. There's a retail component. There's sometimes an educational component. There's a parking component.
There's a hotel component.
How do you help to deal with those components, like to separate them without separating them, basically?
So there has been a surge of those types of properties now being built in the United States, regardless of the location geographically. So we see it in Nashville, we see it in New York, we see it in Florida, we see it in Miami, we see it in Florida. There's an Airbnb condo being built in Florida right now that is totally non-warrantable, and mortgage lenders will not lend a dime into those properties, right?
Yeah, we're actually working on one in Wynwood.
Yeah, so I mean, there's some stuff out there that is totally non-compliant. But when that happens, when we look at commercial space being excessive or too high for Fannie Mae or Freddie Mac or any of the agencies out there, what we typically do is we craft another kind of pathway for that condominium, which is portfolio lending. And we establish portfolio lenders that will lend in the property regardless of Fannie Mae's guidelines. It's kind of important to say that every single portfolio lender in the country still cares about Fannie Mae and Freddie Mac, and now they care about them even more since their guidelines have kind of created so much ineligible product across the country. But that being said, there are still lenders out there that if you get the building as compliant as possible with those agency lending guidelines, insurance policies, and how the bylaws are drafted and how the controls are set up within the building, and how the votes are set up in the building, especially on those types of buildings where you have a hotel and you have a commercial space or an educational space within those buildings, you could get portfolio lenders to lend within those properties, albeit at a little bit higher interest rates than normal, but some are kind of market, especially in some of the big, geographic areas that have a lot of condo, like, Miami or New York City we're seeing portfolio lenders really strong connectivity on the even on the non-warrantable condo side.
That's good to hear.
Yeah.
That's really good to hear.
Yeah.
Are there new players? You mentioned earlier, the landscape has changed a little bit, right? Are there new players in the marketplace or coming into the marketplace to fill some of these gaps as well?
There are. So it's funny, with the last 18 months or so, we've seen a lot of secondary market investors kind of run away from this type of lending. And the discussions that I've had with, most of the big box lenders in the country who have also kind of shied away a little bit from this type of lending are coming back into that space. So we're seeing new secondary market investors create products and programs for non-warrantable condominium properties. I don't think we're there yet. I would love to see a large swath of them. We may have 2 or 3 or 4 lenders nationally who will provide that type of lending, dependent upon the geographic location. But we're getting there. They're kind of figuring out that just because a property may not be 100% compliant, you could still provide mortgage financing into it without that much of additional layered risk.
That's good to hear.
Yeah.
That's really good to hear, because you're seeing more branded residences, more condo, hotel, hybrids coming out, particularly I think in the Florida marketplace. They're coming to New York too. There's some here now, more coming in the future. So having a broader base of lenders would be really helpful. And I think a lot of these properties are actually reasonable risks.
They are. I mean, New York City has kind of figured that out for a long time. There's always been some sort of lending. I think the rest of the country, it really depends. It really depends on geographic location and what type of velocity that area of the country is seeing, right? So if you're doing, we have a condominium property in Alabama, the velocity of sales on a new construction development is really slow. Whereas, if you look at, and by really slow, it's like 1 unit a month, and it's it's really slow. As compared to the New York City market, where, you might get 7, 8, 10 deals a month that come in, depending on a good sales month, and on some of these large properties. And we've seen a lot of really successful new construction developments, a bunch of that you're working on, in the New York City market that has really good velocity, right? So it really depends on the geographic area for lenders to kind of want to step in or not.
That makes sense.
It makes sense.
Yeah, it makes a lot of sense.
Yeah.
All right. Well, we're already almost 13 minutes into this. We have to take a break, and we'll be right back.
I'm Brian Scott Cohen, one of the top loan originators in the country, and the #1 mortgage originator at Guaranteed Rate Infinity. Guaranteed Rate Infinity arguably has the most advanced tech in the industry. Our completely digital loan process makes it easy and efficient for homeowners, from a 15-minute pre-approval to the digital application and through closing. My team and I would love to help you get into the home of your dreams.
Hi, I'm Evan Greenberg with Langdon Title. I specialize in title insurance across New York, helping real estate attorneys, agents, and brokers close with confidence. I solve problems fast and keep your deals moving. Contact me anytime.
All right, and we're back with Orest Tomaselli, my good friend. So, Orest, talk to me a little bit. You mentioned earlier about the awful situation that happened in Florida with Surfside.
Yeah.
We've always, for the past 15, 20 years that I've known you, we've always talked about reserve studies. Tell us and help our viewers understand more why the reserve studies are important and how it works. Because, for instance, here in New York City, let's say I have a highly staffed building where the staffing is half of my operating expense.
Yep.
And the regulatory agencies want a 10% reserve, but you don't need a 10% reserve for human beings. You need a 10% reserve for physical plant. Yep. So How does this all work?
Yeah. It's funny. I was on a call just the other night with an existing established condominium property that has $6 million yearly operating budget, and they had to set aside $600,000 a year, or 10% of their operating budget for reserve, and it was just overkill.
Right.
So the way a reserve study works is our team, and most reserve study firms out there, have a professional engineer or a team of professional engineers that goes to the property and essentially maps out all the common area components in the property, from the roof to the mechanicals to the exterior, even to the carpet and wall coverings in the hallways. And they come up with a remaining useful life estimate of how long that carpet's going to last, or how long that roof is going to last before it has to be replaced. And they come up with a cost of what it takes to replace that specific component. And then we overlay an interest calculation and an inflation calculation. What you get at the end of the day is you get this report. I mean, to kind of summarize this, you get this report, and it outlines in every single common area component cost, and then it provides the association or developer with a prescription for reserve. So at the end of the day, what we give them is, look, you have all of these components. This is how long it's going to take for them to fail, and this is the financial plan for the next 5, 10, 15, and 30 years of this property. Most people focus on the first 5 years, but this is how much you should be setting aside in your operating budget for reserve, instead of some arbitrary number that the agencies have come up with. And they're not at fault, by the way. There are a lot of the agencies aren't at fault. They have to find some sort of middle ground where people would set aside money for a rainy day.
Sure.
And this is the way they did it, with a 10% reserve line item requirement in the operating budget. But the reserve study supersedes that. And what it does is it provides accurate and actual data of what the repair costs are going to be. And it sets up a financial funding plan for the association for reserve. So that's the long-winded explanation of what a reserve study is. But how it's utilized in the industry is actually more important. So on Fannie Mae and Freddie Mac lending, if you provide the agencies with a reserve study, or banks with this reserve study, then they will utilize the prescription within the reserve study in lieu of the reserve contribution. But it tells you so much more about a building. It tells you how much money they have sitting in their reserve account, if they have massive repairs coming up in the future, if they have enough capital today to pay for those repairs, if there are critical repairs or deferred maintenance. And that creates or limits an association or a lender's risk into lending into the property. If you have a really great property or a new construction property, and you're essentially providing a plan for the financial future, essentially it limits risk for that lender, so they'll be more apt to lend in that property.
Yeah.
And that's why that report has kind of skyrocketed in popularity, especially in the New York City market. When I started this about 19 years ago at Strategic, we would do 2 or 3 reserve studies a month, and very few buildings in Manhattan would do it. And now, I think last month we had a record month of, 76 orders for reserve studies in the New York City market alone.
Wow.
And have completed more than 4,500 reserve studies in New York City.
That's amazing.
So,
I find it interesting. I own some property in Florida, and the condo rules in Florida are much different than the condo rules here in New York. The Florida rules actually force the condo boards to have certain reserves, and they have to be line items. So it's the roof, it's the painting, it's the windows, it's the waterproofing, whatever it might be.
Yep.
I was amazed that, because it's weird. Like, Florida's weird, right? Compared to New York. Florida, you market the building, you take deposits, and when you get to 60 or 70% committed, then you go get your construction loan and build.
And then you start building.
Right. And so that seems like very kind of willy-nilly. But once the condo's established, they have a lot of, not restrictions, but a lot of requirements, where New York, that has, the Martin Act, which is this wide spread and deep law that governs the marketing and the sale and the disclosure of condominiums and co-ops in New York, but they don't scrutinize the budget.
Yeah.
So it's interesting that it's almost like the banks are doing the job here in New York, or I know it's national as well, but that some municipalities and states have done as well.
Yeah. Well, look, there's legislative changes that happened in Florida last year requiring reserve
Right,
space
because
for
of Seaside, I assume, right?
Yeah. Surfside, yeah, because of Surfside, that require every single condominium property in Florida to have a reserve study.
Yeah.
That has changed the game, by the way, in Florida, where there are a lot of properties that were woefully unreserved and didn't have enough capital and hadn't done a repair in 10 or 12 or 15 years to the common area components. And that's coming back to bite them.
Yeah, my buddy's mom's condo in Miami just got hit with a massive assessment.
Yeah.
Because they're woefully under budgeted and funded, and they have because of all the structural review that's gone on, they have a lot of structural issues that have to get fixed very quickly. I mean, we're talking big apartments, half floors and full floors, but I mean, these people are getting hit with like $100,000 plus assessments.
By the way, that's not uncommon. That's like really becoming the norm, and that's gonna bleed down into unit value very soon if it hasn't already. We're certainly starting to see that in Florida, where these properties with these giant special assessments are, what's that unit worth? If you're, if you're selling the unit for $500,000 and there's $150,000 special assessment, let's do the math.
It's really interesting.
So it's really interesting. That's what's happening. From a legislative perspective, or from that perspective of whether or not it's going to happen in New York City, there are current bills under review right now that may or may not, we may or may not in the near future have the same legislation in New York City.
Yeah. It wouldn't be a terrible thing. And I know that my developers don't want to hear this, but, when we're doing comps, right, and we're looking at, okay, we're going to build a new building with our client, and a building just went up around the corner that may or may not be similar, and we're looking at their budget. And a lot of times I look at these budgets and I shake my head saying, it's woefully under budgeted.
Oh, yeah.
It wouldn't be a horrible thing, frankly, for the state to set some guidelines. I know there's the 25% guideline.
Yeah.
But, 22% higher is a lot.
It's
24% higher is a lot.
Yeah.
And I look at a lot of these budgets and we don't only urge, but we basically mandate our clients to really put together budgets that are factual and that are really realistic. And I know a lot of developers put pressure on their managing agent to try to push it down, or maybe they're covering certain things for the first year or two so they don't show up in the budget.
Yeah.
So when we look at comps, the buyers say, well, how come your common charges are $1.20 a foot and the guy across the street's 80 cents?
Because mine are right.
Yeah.
I mean,
that's the
right answer.
Yeah.
It's so funny how we've seen over the years, firms kind of obfuscate that fact from prospective purchasers. And you know what? It comes back and bites them. And, it's no secret that the profit in the new construction condominium world is on the last units that are sold,
always.
Right? And that's, you're 3 or 4 years into a sales cycle sometimes before those last units are sold, right? And that's when everything is biting.
Right, because that's when the budget actually gets to a point where it's the real budget, not the forecasted budget, not the potentially under forecasted budget, and it's usually your most expensive units. It's your penthouses, it's your high floors where you are holding out maybe for the market to change, or maybe just for the building to be completed, because we know in a lot of development projects, the amenities come last.
Yep.
We really urge our clients to build them first because people hate waiting.
Yep.
And then you're right. And then 3-4 years go by, and now all of a sudden the budget is righted, right? And now those
such
common
happy
charges
people,
are 20% or more, maybe by then more because of inflation.
Yeah.
I mean, could you imagine you built a building, or had a Schedule A approved in 2021, and now it's 25, and we have tariffs and we have all kinds of things, and the cost of everything is up.
Yeah.
And now you're trying to sell that apartment and get your profit, and it's harder.
It's much harder. It's much harder if you don't have the right numbers on day one.
Yeah.
And we've seen that happen over and over again. And it also is a catalyst to litigation, right? And it's kind of like the first step of like, well, look how off this is. What else is off in the building?
Yeah.
And the smart developers and the smart, the folks who actually do their due diligence and provide the right numbers right now, those are the ones that aren't dealing with those types of lawsuits.
Right.
And look, those are company killers in some instances.
Yeah.
And it's a big issue. So,
Yeah.
but yeah, we see that too. We see that a lot.
Yeah, we see that a lot. Something that also recently came up that we don't deal with that much in Manhattan, but we are now working on some projects in Florida and certainly in New Jersey. The parking component, and how the parking is described in the offering plan and who has control of it. Help our viewers understand that, because I didn't even know about that part, and I thought I knew almost everything when it comes to compliance and lending.
So here's where it comes back to Fannie Mae and Freddie Mac agency lending guidelines and how they direct the market in so many ways, even in portfolio lending, right? So essentially, the goal is for a homeowners association to have control over its destiny. That's the end goal for the agencies, because it's less risk, right? It lets them control what's happening in the future. That's true for condominium properties that have a hotel component and a condo component. They want the residential component to have control over the future. So what we started to see is that developers want to retain control of the parking component in the property. Retaining control of the parking components in the property makes them ineligible for residential mortgage financing through Fannie Mae or Freddie Mac. So, yes, you could sell the parking component to a third-party provider provided that third-party provider is really not the developer, right? Which we've seen a couple of developers try and skirt that issue.
They create another entity.
All of that. But at the end of the day, that's why it's so important to get it right on day one. I will tell you that I probably see 10 to 15 offering plans a year or proposed condominium developments a year that have an issue with parking on day one when we review it. And we have to go back to the drawing board and redesign the property in some instances because they didn't do their due diligence on what was going to be allowed by the agencies on day one.
Right.
And but yeah, it's unfortunate, but that delay can sometimes be a really long delay to get to the sales table, right? Because if you don't have residential mortgage financing for the first purchasers in a new construction condominium property, you're kind of dead in the water. Yeah. You're only selling to cash buyers. It's disastrous for a developer. So, yeah, I wish everybody did the due diligence as you do and kind of do the kind of has the knowledge to be able to kind of provide that sort of guidance. When it gets to us, it makes our life a lot easier.
Yeah. So with shared amenities or components like that, you come up with that, I guess, with the condo hotel situations if they only have one lobby, right? Things like that as well, right?
That's correct. What's more common is some sort of mandatory membership to some sort of amenity in the space. That's what we've started to see a lot with hotel condo properties, and that is totally a non-warrantable property through Fannie Mae and Freddie Mac's eyes. So, there's lots of ways to construct that condominium so that it is compliant, and so that you essentially firewall these, associations in such a way so that you protect the residential unit owners. Again, it's all about protection of the residential unit owners within the property.
Right.
The agencies could care less about the commercial parts of the development because they're not they're not lending on the commercial side, right? So they're lending on the residential side. So if you kind of keep that in your head when you're designing a property, especially around shared amenities and parking, and again, it gets really tedious though. I mean, we've seen some, bylaws that it's buried in some of these bylaws of how these amenities are owned and or how they are shared and what the fee is. Sometimes it's not even in the budget for some reason. There's some crazy stuff that we've seen out there.
Yeah, and these private clubs within condominiums have become much more in vogue lately, right?
Yeah.
And I guess the point is, if it's basically baked into the condominium is either part of your common charges or a mandatory add-on annual fee, that's a problem. If it's a private club and you can join it or not, then it's not a problem.
Not
because
a
then it's
problem
not
at
seen
all.
an amenity,
It's
right?
not an amenity.
You're not taking something away if, God forbid, they close.
It's like, we
Right.
see in New York City, we see it with the gym contracts. Actually, I think we were responsible for all the gym contracts changing in New York City because every single one of them had this mandatory membership
Right.
for the prospective unit purchaser.
Right.
And every single one of them was ineligible for residential mortgage financing, and those contracts all had to be unwound.
Yeah.
So yeah, it has been a really big issue, and especially now that with the resurgence or, the surging development that, the condo development type or class that's, hotel condo or, amenity rich condominiums, we're seeing it all the time.
Yeah, it makes a lot of sense.
Yeah.
We didn't talk about this before we started recording, but you and I were talking earlier about AI and how AI has impacted a lot of industries. Do you see AI impacting your business? Is it helpful for your business? Is it something you guys utilize? It's the biggest buzzword of 2025. I actually think Time Magazine made AI the person or the thing of the year.
Right.
I saw that on one of the news programs yesterday, and they said, it's not a person this year, so I'm assuming it was AI.
Right. Yeah, look, it's really like in my personal life or business life, I use AI every day. Right. I mean, I throw so much stuff into Chat GPT. Usually I'll do a presentation or I'll write an article.
Right.
And then I'll throw it into AI to see what it catches and how it rewrites it. Or it's kind of scary because it's spitting back information to me now that I wrote in that I posted to AI 3 weeks ago.
I know, it's funny. It's catching your own articles and giving you back stuff, right? Wait, you left this out.
It's really odd.
You contradicted yourself.
Yeah, it's very strange. It's very strange. But it depends on what side. Yes, I think some things are eventually going to get better with AI, especially data. So at CondoTek, we're a tech company, right? Essentially, that's, we collect all this data from condominium associations across the country. We warrant condominium properties at CondoTek, and we provide documents and data to over 800 lenders across the country. And I think that's eventually going to help us collect that data. The various stakeholders within the industry, I think the AI will get them to the place where they, eventually will be able to get that stuff to us quicker, faster, better, smarter.
Yeah.
It's going to take a little while. I don't know if that little while is a year, 5 years, 10 years. I think right now, nothing is better in my industry than somebody kind of picking up a package of documents, reviewing them all, understanding the legal documents, understanding how they relate to agency lending guidelines, and coming up with a decision based upon that review. It's very hard to get AI to kind of collect all that information at once and make a decision. So eventually, yeah, sure, I think we'll get there, but I think I read something somewhere that was like 5 years from now, the AI is going to be smarter than any human that's ever been alive.
Yeah, it's unbelievable. It really is. And we use it kind of the same way you do. We'll write a report, we'll throw it into AI, see what it suggests as tightening some things up or pulling some information that somehow we didn't have.
Yeah.
I think in the future it'll be even better. I think it gets even better when the governmental agencies start allowing, them to pull data as well, right?
Yeah.
Because then you can really distill it a lot faster, and you can, you can kind of, throw the junk to the side and just be looking at the relevant data that you need.
Yeah. But I'll tell you, it's still really disconcerting when it reads my own words back to me.
Yeah. Oh, I hear you. I get it. It's always disconcerting when somehow it has information on your competitors that you don't even know how it got. Like crazy information that's not published, but somehow it has it.
I haven't delved that deep into that. Now you're making me think I should. Hold on a second.
It's really weird. We've thrown some things in tell me about a job description for a project matter in new development, and it literally spits out our competitors' information. But this wasn't information that was posted on LinkedIn or something. I don't even know how it got it.
Wow.
Yeah, it was really, really wild. But
they're using AI, and they put it in, and then the AI spit it back.
And then AI grabbed their own information, and
now
they're holding on to it.
That could be it.
Yeah. Yeah, exactly.
Wow.
So you have to be careful about what you put out there, because there's eyes and ears now that you didn't know existed.
Yeah. Well, my father was Sicilian. I've always kept a really tight lip. I'm learning more.
Well,
and
in
more.
our industry, tight lips is all you have. I tell people all the day when they'll say to me, "I'm going to send you an NDA." I said, "I'm happy to sign it." I won't even read it, because my whole world is non-disclosures, and my whole world is private information that if I let slip, I'm never getting another job.
Correct. And
Yeah.
I have the same exact conversation. It's actually very funny. And I sign every NDA instantly because it just doesn't matter.
Yeah, exactly. Because we're never going to talk about
I'm
it.
never going to talk about
Exactly.
it. Oh, do I have stories?
Oh, we all have
One
stories.
day.
Yep. Orest, it's been a pleasure. It's been a pleasure working with you for the last 20 or so years.
Very much the same.
You are a icon in the industry. I mean, nobody doesn't know your name. I appreciate the time spending with me, and I hope our viewers learned something today. And if you have any developments that you're working on in the future, he is the guy to call.
Thank you very much. The same here. Thank you so much for having me.
It's my pleasure.
Yeah.
Till next time.